Every week in the Learn by Example investor community, I go live for about an hour and answer member questions. And a couple of weeks ago, I got a question that was really interesting around how to invest in businesses that are being acquired. And since we have a multi-billion-dollar acquisition still pending with a 23% upside between the price of the stock and the acquisition price, and one where Berkshire Hathaway is getting involved in the action, so I want to talk about how I go about navigating these situations that Warren Buffett calls a workout or a risky arbitrage. And we can also hear from Warren Buffett himself, who spoke about this at the latest Berkshire Hathaway annual meeting. On a side note, if you do want to become one of the 300 members in our private investing platform and community and get access to over 150 hours of exclusive content, then at the moment, Learn by Example is taking new members for the next couple of weeks. As always, these spots go really quickly, so if you're interested, make sure you take a look down in the description below for all of the information, and there'll be my email address down there if you have any questions before joining. So the question that we're going to be covering in today's video was asked in the community, and the question was this: can you offer a perspective on how to think about merger and acquisitions of a company that you own stock in? And then he provided some assumptions. It's a company that you own stock in is the one being acquired. The company you own stock in trades slightly below fair value, and the company you own is in your circle of competence, whereas the other one isn't. And immediately when this question was asked to me, I of course thought to one of the biggest acquisitions, probably the biggest pending acquisition at the moment, which is the acquisition between Activision and Microsoft. This acquisition was initiated a few months ago now, and at the time the offer price was $95 per share for a total out-of-pocket of $67.7 billion for Microsoft, making the acquisition of Activision. Essentially what that means is that Microsoft will be paying Activision shareholders $95 per share, which works out to be about $74 billion. And the reason why Microsoft's out-of-pocket is only 67 is because they then, once they acquire the business, of course, get to collect the cash and make the debt payments for Activision, which is a net cash position of about $7 billion. So if you think about the net cost in terms of cash for Microsoft, it comes out to about 67, but shareholders will be getting $95 per share. And there's a really key reason why Microsoft is interested in acquiring or looking to acquire Activision and get access to a massive game developer and a game library and a lot of IP for game franchises. And that's really the continued expansion of their Game Pass membership, and ultimately the long run for the gaming space, I think, looks very similar to the video streaming space or the movie streaming space, in that gaming will be done mostly or entirely through the cloud. So similar to streaming services previously, the internet bandwidth wasn't strong enough for you to be able to have a constant smooth stream of a movie. So you either had to download the movie onto your computer over a certain period of time, or you had to get a physical disc, right? The same kind of evolution is going to happen in the gaming industry, in that at the moment bandwidth isn't enough for a game to be running completely, or at least an intensive game to be running completely on a Microsoft server, and then you can just stream that game through the internet connection. But internet bandwidths are continuing to improve, and they will continue to improve. And as a result, cloud gaming makes a lot of sense. It also opens up the opportunity for you not to be tied down to a specific hardware. Potentially in the future, you would be able to stream cloud-based games, even very GPU, CPU intensive games, just using, say, your smart TV. So how should we think about this kind of deal from an investment perspective, a value investing perspective? Well, fortunately for us, Warren Buffett through Berkshire Hathaway has invested significantly into Activision, and they did this before the Berkshire Hathaway annual meeting, so they had a discussion around it at the meeting a couple of months ago.
Now, when they announced that, at that point, Activision becomes a different kind of security. It becomes what Charlie and I used to call, well, everybody did, 50 years ago, we call them workouts or something like that, and they become known as arbitrage. Well, they're not really arbitrage, but they're securities, they're, in this case, a common stock, whose value depends not on what the market price does, but whether a given corporate event occurs, an announced corporate event occurs. Well, Microsoft wants to buy Activision, we'll say. Well, they said at $95 a share. And they've got the money, and obviously mergers and big mergers, tech companies, all kinds of things, have got all kinds of problems with the world generally in terms of opinion. So You don't know what the Justice Department will do, or you don't know what the EU will do, and there are all kinds of things. But at that point, it becomes a different security.
Essentially, the idea here is to estimate the probability of a corporate event occurring. In this case, what's the probability of this acquisition going through? So what's actually holding up the acquisition? Well, first of all, when the acquisition was announced, we were waiting for approval from the shareholders of Activision. That approval came through on the 28th of April, where the board of directors essentially approved the deal. And the stock moved slightly up on that announcement, but there was no real major change. And that's because there's one other thing holding up, or one major thing that's holding up this acquisition, and that's the FTC. The FTC, or the Federal Trade Commission, has to approve this deal, and the question really here is whether the acquisition would breach antitrust regulations. Antitrust regulations being those in place to protect consumers from anti-competitive behavior. As a recent TechCrunch article put it, as a publisher, platform, hardware maker, and service provider in gaming, Microsoft's acquisition of Activision Blizzard puts several of the world's most popular gaming franchises firmly in its stable and potentially out of reach of arch-rival Sony. The acquisition raises a lot of questions, especially around how gaming currently functions, at least for console gaming, where Sony and Microsoft can kind of gatekeep franchises by owning the IP of those franchises and preventing console holders of the other company from playing those games. This matters less over time as we move into a cloud-based format, because of course Microsoft will potentially be able to offer a Game Pass where you can play games and you can download that app potentially on a smart TV or a set-top box or some other kind of device, and not an exclusive Xbox device. But it's unclear whether the FTC will actually consider the long run for this industry. That's really uncertain at the moment in their current decision. And then when it comes to figuring out how you should think about the investment as a place in your portfolio, potentially you could use something like the Kelly criterion for sizing the position based on the probability of the event occurring. The Kelly criterion is a mathematical formula used to determine how much to invest in a given asset in order to maximize wealth growth over time. The basic formula has two inputs, a winning probability and a win-loss ratio for trades in your portfolio, and the output would be the percentage of your portfolio allocated to an investment. Problem with this is it's very difficult to maybe impossible in many cases to actually get to a percentage probability of a certain event occurring or an investment succeeding. I tend to look at investments from the perspective of only taking bets where it's very, very likely that I will succeed, rather than trying to estimate a percentage of success and allocate accordingly. And if we assume that it's very difficult to actually figure out to a reasonable degree of accuracy what the chance of this acquisition going through is, then you need to still be applying key value investing principles to the investment with some level of assumption that the acquisition may fall through.
The profit is limited. If they say you're going to get 95, you're not going to get 96, and if the deal blows up, you may have a stock that's at 40 or something. So
essentially what this means is we need to be happy buying the stock at the price today with the assumption that the acquisition fails, that we just own Activision, we don't get the $95 from Microsoft. And the reason why it needs to be a great company and we can't just bet on the acquisition is because if it fails, it's very likely the stock will fall, maybe significantly, meaning we have to be happy to hold the business over the long term. So that means going through the normal process of making sure it's a business we deeply understand, making sure it has some kind of economic moat, some deep competitive advantages, a business that has an amazing management team, good at allocating capital, a trustworthy management team, values aligned with ours, and a business that's in great financial health. And then we need to estimate what the business is worth and be paying less than intrinsic value. In a special situation like this, which I haven't personally partaken in before, I think it would be reasonable to take a smaller margin of safety on your valuation of the business if you think there is there's evidence to suggest there's a very, very high chance that the acquisition will go through. So you'd still want to be buying the business undervalued, but I think it would be reasonable to have a smaller margin of safety given that the chance of the acquisition failing may be less than the chance of it succeeding. As I mentioned at the beginning, if you want to join our 300-member private community and get access to a bunch of exclusive content, including example stock analysis reports and presentations, questions where I've analyzed real businesses so that you can see how I'm going through the process and see how I'm applying what I spoke about in the checklist video that I posted a couple of days ago. If you haven't seen that, go check it out. But if you're interested in joining, there's a few spots open up at the moment. All the details are down in the description below, and you can get 30% off if you use the code June22 at checkout. So go check it out if you're interested. My inbox is always open for questions before you join. And of course, if you do join, you'll get access to me to answer all of your investing related questions on an ongoing basis.